You want it on this?
Yes,
Is this
please.
good?
Yes, please.
Okay, fine.
All right. Welcome everyone. Happy New Year, guys. It's been a minute. It's been a minute. Fun fact, Bibi. That track that was playing, and you know my son plays the violin, so I like violin. It's called Ice Storm, and that's in honor of your shut down because of your thin sheet of ice that Texas is experiencing. Meanwhile, we're going to get pounded over here with snow. So I do see a few new, maybe they're not new, but they're new to me, newish faces. I don't know where you guys are from. Pavel, I believe, is up north here in oh, come on, Dacia. It is not cold. What is the definition of your cold? What, 50 degrees? Excuse me. Um, but yeah, no, just kidding.
Actually,
Welcome.
I think high 30 and low 10. So we are getting there.
Welcome to what we consider, oh my gosh, is it really this nice in winter? This is amazing. That's what we've we've been experiencing. It's winter. It's real winter. We don't joke when we hit single digits and then when we go below, right, Pavel? That's when
That's
we now
right.
say, oh, okay, all right, it's winter. But 30s? No, it's like, whoa, did
Cold
spring
for us.
swing by? All right. So welcome everyone. Happy New Year to all the asset managers in the room. Let me go ahead and get started. I believe we are recording. 1 second. Let's share this. All right, for anyone who might be new in this room, this is the asset management series that holds every other Monday through the MFC platform. We're part of the MFC group. And I think the last time we met, which was December, clearly, but we had part one of our transact module, so to speak. And so we'll be wrapping that up today. And today we'll be talking about optimizing exit strategies, which is similar to what the last title. So it's optimizing exit strategies in multifamily asset management. And this is the second part of that series, okay? And my cursor has frozen. Give me 1 second. Awesome. It's just circling and circling. I apologize. All right. Well, while it's circling, let me tell you, I know what's on the next, slide. Bibi, you'd have to admit people because my thing is going around in circles. But for those who are not familiar with, the multifamily freedom chasers, we're a group of individuals who believe in empowering 9-to-5ers, and if you're not a 9-to-5er, that's fine, in attaining financial freedom through commercial multifamily. Boom, there we go. Through commercial multifamily investing. And so we have all this free content that we put up, and I think I'm still somewhat frozen, so I'll just take what I can. The asset management series is run by, maybe you may have to end up sharing your screen. I'm not entirely sure what's going on with mine, but let's keep going. But the asset management series is run by Bibi, my co-host, Ofiri, who has what, 13, 14? Is that you sharing?
No, you.
This is me?
Mm-hmm.
Oh, awesome. Who has 13, 14 years of experience in asset management? It's still circling all around. And we're in the Pennsylvania and Texas markets. My name is Ify. I'm a pharmacist. I'm about 1.5 years, almost 2 years into commercial multifamily investing and giving back through this platform, which is not working for me right now. So hold on 1 second. Give me 1 second. Sorry about that.
So let me just chime in while you're trying to figure that out.
Yeah.
Yes, Happy New Year, everyone. It's really good to see us again. Just like what Ify said, this is the last episode. But before we move into the new one, I would like to give an overview of what we discussed the last time, because it's very important that we understand the complete picture of an exit strategy. And before I go ahead, I know some of you are like, how does this imply to me? I don't even have a deal. I'm not on a team yet. I've not done anything. Why should this be very important for me? The reason why this is important to you is because of your long-term goals. For you to be here, that means you have an intention to one day own your property, partner up with people, and start running them. The more knowledge you have, the better value, the better the more valuable you become on a team. In the sense that it's the knowledge you have that is what will take you to the next level. Imagine yourself being on a team and you don't know anything about asset management. That might be very difficult for you. So get as much knowledge as you can. So when we get to that time, then that becomes very easy for you. If I don't know if I said.
Oh, hold on, let's do a little test here. I think we are.
Okay.
And if you're already on a team and you represent the newbie in the group, or you have some experience as well, I think the information that's shared here will only help add to the knowledge and the information that you have in your skill set as well. So you can't go wrong by sitting in rooms like this.
Correct. So let's recap on exactly what we did the last time. We spoke about different exit strategy. We're talking about different ways we can exit a deal. And we mentioned refinancing a deal. We also mentioned sales, that means selling a deal. And we also mentioned the most easiest part of it, foreclosure. That one, you don't need to do anything. It's just very easy and you get foreclosed. So, but that is not the aim of this meeting. Our aim is to educate us on how we can exit on different deals, because the main purpose of us buying a deal is to exit in a profitable way for our investors and also for ourselves. So that is the major goal. So to recap, last week we talked about, the last time we spoke about market timing, market trends, market timing. Let me just say what that is. The most important thing in exiting a strategy is your business plan. You need to focus on your business plan. And what is a business plan? We explained it the last time that a business plan is just like an overview of what you want to do on the deal from day one to the end. And it must entail your exit strategy. What year do you think is to be a good time for you to leave the deal? So exiting a deal is very important for you to align properly with your business plan. But does that mean that when an opportunity comes, and let's say your business plan to exit is 4 years, and you got an opportunity, you've done everything you need to do, you've done your value add, you've increased rent, everything you need to do has been done, and it's time for you to exit. Is it that do I have to, because I said 4 years on my business plan, does that mean I should wait until that 4 years before I exit when there's an opportunity for me to do that now? No. So as much as you have a business plan, you also need to concentrate on the market timing. For example, look at where we are right now. We are in a time where the interest rate is very high. Imagine if the interest rate goes low next year and you've executed your business plan. That means you've increased rent, you've done everything you need to do. Next year might just be the right time, irrespective of if your business plan was to exit in 3 years after that. Don't also forget you need to also take note of your debt conditions, meaning that if you have prepayment or yield maintenance, those things have a great effect on your exit. So you need to also take cognizance of that and see how it affects your timing. The next one is market trend. What is the market saying? How should I follow? Exit strategy planning, financial performance, valuation strategies. I will explain this towards the end again. Our valuation strategies is more of the appraiser. How does the lender appraise evaluate your property at the time of exit? There are things you need to do so that your property becomes more very valuable at the time of exit. Then due diligence preparation, there are things you need to do, like preparing your T12, your T1, your T12, your rent roll, your profit and loss, many things you need to do in order for you to properly exit at that time. So
So this is, when I was preparing for this, Bibi, I felt this was kind of like how we should live life. So when you're the underwriter, or whoever is the underwriter, you're you're thinking of the end from the beginning.
Yeah.
Right? You're going with the end in mind. Unless, of course, it's a, I don't know, a legacy property and you're never going to exit, but it won't be emphasized, but you're always thinking about the end from the start, not 2 years into it, you start rushing to try and execute something. So I guess it's pretty interesting.
You just brought something to my mind. The main purpose of a deal, because if you buy a deal, and some of you have the long-term kind of mentality, meaning that you can hold on to this property for the next 15, 20 years and you not want to exit. Maybe because like what Ify said, maybe it's a legacy property and all that. The main purpose of buying this property is to exit at some point, because at some point you will get to that peak where you've already accumulated a lot of equity and the property can no longer move forward. That is when you start seeing your returns start to depreciate, like your IRR. As many of you that are conversant with underwriting, if you check, when you start making your whole time too long, you see that your IRR begins to decline. It means that it has gotten to its peak. You need to exit at that point. You need to leave before it starts declining. So one of the most important thing about exiting is for you not to accumulate a lot of equity at some period of time, because it no longer makes sense. At that point, you are no longer profiting from the deal. So let's recap. As a strategy, in terms of refinance, we talked about the two in the last time. We talked about different things you should consider when you're refinancing your property, which is one of the exit strategy, is your exit price. And what I said about this is, if you intend, let's say you bought a property for, let's say $1 million, and you intend to exit at maybe 1.5, that means you have to work your way backwards, meaning that you need to accumulate as much as an additional 500,000 equity on that deal. That means it now becomes 1.5. If you cannot accumulate that, then that means for you to refinance and get the kind of profitability you want might not be possible. So it's very important for you to take your exit price in cognizance of your business plan. That means your business plan must be very realistic and must be able to provide that additional income that will help you refi. Another thing you need to consider is your cost of refinancing. Remember, these things comes with cost. 1% goes to the bank and everything. All those things are a lot of money, and it might bring down the cash out refi. That means the money you want to take out, it might reduce it. Then another thing you also need to consider is your interest rate. At the time of exit, let's assume you are refinancing, which is what we're talking about. You need to consider your interest rate at exit, because, for example, if you bought a property at 3% interest rate and you want to exit in 2 years, remember that in 2 years, interest rate might reduce or increase. So you need to be very, very conservative and say, right now the interest rate is 3. Maybe when I'm exiting, it becomes 5. For some of us that bought properties in 2020 and 2021, and maybe our exit strategy was in 2023, we faced this kind of challenges because nobody knew that the interest rate was going to be as high as 7.58% as this year. Nobody had that. I'm not sure anybody underwrote a deal towards that. So these are things you need to consider. That's why so many deals cannot exit now, because some of them went in at 3% interest rate, and right now the interest rate is not convenient for them to exit, which indirectly will affect the DSCR. One of the things the banks will consider before they refinance your property is your debt service cover ratio, meaning that at what point do you become profitable? Most banks is 1:25 or 1.25. Some I see it as high as 1.30, 1.35, depending on the bank's ability to take up some risk. So these are things you need to consider, irrespective of the fact that you say 3 years is my year and you're not able to debt service, the interest rate is so high, you might need to push further ahead. So for us, what we did, because we bought properties during that time and we're not able to refi because of the interest rate. Our interest rates were about 4.1 and 3.9, and exiting now would have been a disaster for us. So what we decided to do was to take a second position on it to pull out equity and wait while we refi, while the interest rate comes down a little, then we can now exit. So these are things you need to consider. Then appraised value. This is very important because the bank is going to look at what is the value of this property. Your NOI at this point is very, very important. NOI is net operating income. What is the NOI at exit? Remember, what is your exit NOI? You need to work your way backwards. So if like I said, if I need to raise exit with 1.5 million, then that means my property will need to be producing 1.5 divided by your old time. Let's say your old time is 5 years, or let's say 3 years. 1.5 million divided by 3 years. That is the amount your property should be producing each year for the next 3 years. So you need to take that into consideration. Therefore, as a strategy, sales, this is very similar to refinancing, but just that you just need to put yourself in the buyer's shoes. Are you going to buy that property at that price? If you know you can, that means everything that you need to every condition that you take when buying a property, that means your buyer will also do that. So you should ensure that the property is good enough for you to buy before you say you want to sell to another person. So this is just a summary of what we did last week. So Ify, I will allow you to talk about this before we move into
Awesome. Yeah, so for today, what we're going to go over are the strategic property enhancements. So how do we, and when do we, and what are the steps, that we're going to take in order to position our property in its best light, keeping the fact that we're going to exit at some point in mind. And remember that thing that Bibi talked about was think about your potential buyer. If you're the potential buyer, would you buy it in the state that it's in or in the state that you want it to be? And that was something you kind of talked about recently, right, Bibi? You said you're seeing more sellers that are syndicators. We're seeing less and less mom and pop type, yeah. And so another thing we're going to, review are the marketing and exposure activities that we can engage in, tax planning for exit, and then navigating legal and regulatory aspects, and then again, sell or refi.
Yes, so the next is strategic property enhancement. When you are looking at selling your property, you need to maximize the asset value through targeted improvement. We bought a property recently, and congratulations to us. We bought it 5 months ago, and no, 4 months ago. We bought it in August ending. August ending, 24th of August.
Five-ish, yeah.
And come first week in February, we'll be giving our distributions to our investors. So I'm super, super excited about that. So I'm going to use that property as a case study. Before we bought that property, the owner did this in the sense that he had some deferred maintenance, but because he was going to sell, he needed to do some property enhancement. What did he do? He changed the roof before we got there. He did some boiler replacement. He did some very heavy lifting before we took on that property. So when we came in, the property was like so good to be true. Why is there no capex on this property? The only thing he didn't do for us was the interior and all that. So if you are selling, you need to consider you need to improve your property. You can't just leave a property looking with having so much damages and repairs and all that. This is a period you need to start doing some improvements on them. Then the other thing is for you to brainstorm with your sales broker to determine what might make the property more attractive. At this point in time, this is the time for you to engage your broker. I've seen people trying to sell themselves, and there's a difference. I've bought properties off market, and I've also bought properties from a broker, and there's a difference between the two. One comes with a better packaging, a better, there's a part in the OM, which is the operating memorandum, that explains what value add you can put on the property and all that. That is what a broker will do for you and all that. So you need to engage a broker and to ask them, if I present this property the way it's looking, what do you think? What would be the objection from my potential buyers? Brokers are very, very exposed. No, seasoned broker, not just brokers. Seasoned brokers are exposed to sales. They will be able to give you little advice on what to do in preparation for you to sell. Some of them I've seen cases. I don't know if some of you have experienced this. You go to a property and they will tell you that 5 of the units have been renovated, and they've increased it to the market rate. The reason why they are doing that is very strategic. They want to what they're trying to communicate to you is that if you repeat these things we've done in this 5 units, you do it to the remainder of the unit, you'll be able to get the increment from you'll be able to get the market rate. So these are things you need to consider. Engage a seasoned broker and have this conversation with them way ahead of your sales period. Ify, do you have anything to say about this?
I do. I remember looking at some assets last year, whenever it was, and in some cases, I don't know what the owners did, and maybe they just didn't use seasoned brokers, but by the time they tell you everything that has been done, your question is, so what's left? You know, there's no meat on the there's no meat on the bone. So while you do this, you have these. That's why I guess that's why it's called strategic, right? Because you don't want to go to the other extreme and then renovate all the units and then do all the capex and enhance the product to the point that there's no value add left for the person that's coming on. So I think you'll be shooting yourself in the foot using that strategy.
Exactly. Exactly. Business life. Marketing and exposure. This is for you to create effective marketing strategies, just like what I just said. Let me reiterate again. Involving a seasoned broker is important for doing your exit strategy. Don't try and do the DIY kind of mechanism. Let me do it myself because I want to save some couple of dollars. That is not important at this time. What you're going to, the end goal should be the most important thing at the back of your mind. How much am I going to get from this deal? How much do I need to sacrifice for me to get this amount I'm looking for and all that? So, and don't forget, part of the broker's fee is attached to your closing cost. So these things must have been budgeted for doing your underwriting and all that. So you need to collaborate early with a seasoned broker. I've seen some brokers, I see what some owners do. Some owners, what they do is they engage different brokers and they want to get their perspective on what their property is worth and what kind of people that their property can attract. So what they do is that they put the property on the market for a period of time and you get some inquiries for those properties, and after a while you just hear that the property is no longer on the market. The owner decided not to sell. Don't be mistaken, these things are intentional. They want to see the feel of the market. They want to see what the market is doing, and
they're testing the waters.
Exactly, they're testing the water. But sometimes it can come back and shoot them in the head, because it happened to me. We wanted to buy a deal. The owner did that. He engaged the broker. They were trying to test the market, and they found out that they were really attracting a lot of people. But the problem they had was the timing. They did not know that was the best time for them to exit. Now they brought back the property to the market. The property is no longer what it was a year ago, and now they don't have that much attraction. The property as at Friday was sitting on the market. So you just need to be careful about that. The next thing is the brokers are very, very exposed to a large network. You can what do you call it? You can leverage on their platform to sell your properties. As many of you that engage brokers, before you even engage a broker, they will tell you to fill a form. Once you fill that form, you get to start having their update. So this is how they get so many people. They have a large exposure to so many potential buyers. So it's very good you leverage them, their network, to do what you need to do. They can also help you prepare a very, very beautiful operating memorandum. There's a particular brokerage company when you engage them to sell your property, the total package of how they present your property is so overwhelming. They will create an operating memorandum for you. They will not just do that. They will give you a tax estimate for their deal. They will give you a water consumption, meaning that if you are able to engage a water consumption company, you should be able to reduce the cost of your water usage on this deal. They will also give you a debt quote, and sometimes they even give you a perspective from a property management company. So it's really, really a full package. Anytime I'm doing a deal or underwriting a deal from that brokerage company, I enjoy it because it saves me a lot of stress. But that does not mean I don't do my own verification at all, but at least it will help me in my first stage underwriting. So these are things we need to do when we are marketing when we are thinking of exiting. So the next one,
All right, so give me 1 second here, because I don't have much on my slide. So I just wanted to talk about, the 1031, the principle of a 1031 exchange, which is one of the new things I learned in real estate. It's pretty nifty. And so the principle, I think the name comes from the IRS everyone here probably knows what a 1031 is, but for the few that may not, or anyone that may be watching this after, the name comes from the IRS section code 1031, I think is what it is. And essentially, when you sell a highly appreciated asset, which is what you're hoping and what your business plan should convert your product into. So if you sell a highly appreciated asset with depreciation on it, normally you'd be subject to pretty sizable amount of, state and federal taxes. And so you can avert this using two tax deferred strategies, which is the 1031 exchange or using a refi. I actually heard something about 1031 exchange. It's kind of referred to as swap until you drop. So people keep swapping out assets until they pass away. There are a couple of things to think about, and Bibi, I know you can speak about this from personal experience with what has happened to you, but there are a couple of rules and things to consider if you were to go down the 1031 exchange route. So the asset that you are giving up, or the asset that's been sold, the asset that you're relinquishing, which is called the down leg, has to be, or what you're purchasing, I apologize. So what you're purchasing, the up leg, has to be of equal or greater value based on the net sales price, if I remember that correctly. And then you can reinvest all the proceeds into this, into this new property. So there are rules with the amount or the cost of the asset that you're going to get. There are rules with timing as well. And I think that's where the tricky part comes with the 1031. Your intermediary, the qualified intermediary, the person that's going to handle the transaction needs to be informed within 45 days of close and of close. And so you need to let them know in writing. You have this time limit of 45 days. You have 180, I think, calendar days that you have to now buy the replacement property. It seems like a long time, but it really isn't with commercial multifamily. It seems easier to do with single family, but it's certainly something that you can engage an intermediary early on. You can engage it because you also need to set up the 1031 exchange account. You're not going to handle that money upon sale. It needs to go into this account, and then that person handles it for you. And so those are kind of things to think about. Another thing to think about, which is something that I think we kind of sort of experienced with one of the assets we acquired, is what kind of market. Remember Bibi on one of the slides, she talked about market timing. What kind of market are we in? So if you have an asset and you intend to go through a 1031 exchange as the seller, well, what if we're not in a seller's market? What if we're in a buyer's market at that point in time? If you're in a buyer's market and the buyer knows that TikTok, you have a lot of, you have, time on the clock. they could hold you, they could hold you for ransom. You don't have you lose a lot of leverage. You lose a lot of leverage because everyone knows you need to really hurry up and get rid of that
If you
asset.
let me give them an example of what happened to us 2 weeks ago.
Okay.
It's so funny. Let me just say this and you can continue.
Okay.
We are exchanging some of our vacation renters to multifamily. So we sold one of our vacation renters in California, and we decided to do a 1031 exchange to buy a multifamily with it. We identified the property because you have 45 days to identify a property after you close. So we identified the property on the 45th day. Because for some reason my broker he went for vacation and he used 35 days on vacation, and he came back 10 days after the vacation, and we're running a taskettle looking for the replacement and property, and because of the desperation, we just jumped into anyone, So the owner already knew that we're desperate. So he gave us for a premium price. That was not the issue. We wanted to just exchange the property. We took on the property and all that. Another thing happened. During it was Christmas period. Before we knew it, our lenders were not forthcoming. They were traveling and all that. We think we were going to get an extension from the buyer, and the buyer said, "I'm not extending." So we lost out on our 1031 exchange. Now, because we are professional investors, there are other ways we can write off that capital gain, because we have a lot of K1s, a lot of write-offs we can use to write it off. That's why we are not sad about it. But imagine someone that is not a real estate professional and all that. You damage to pay a lot of money to the government. So I just wanted them to know that things can go wrong if you don't.
Yeah, things can go wrong. It's a balance with this. So there's timing involved. It's almost like a matchmaking service that has to happen, because the property, you can identify up to 3 properties, I think. The cumulative amount can be more than 200% of the asset that you're leaving. But the timing, I think, is what kills most people. And so you find that people are now willing to just buy things that are not cash flowing, buy things in desperation, just do all of that. So you don't want to find yourself in that situation, because this is supposed to, again, it's not tax-free, but it's tax deferred. And so this is supposed to be helpful. This is a helpful way of growing wealth, if you can just keep deferring these taxes and acquiring new assets that you can add to your portfolio, increase your overall wealth. And so refinance is another way you can go in terms of tax planning, because the IRS does not treat the proceeds from a cash out refi as income. So instead of selling your property and triggering off capital gains tax, which you probably will if you stuck to your business plan, you could secure a larger loan, pay off the old one, and then take out the difference as cash. That's cash out refi. And so, but that's different from a supplemental loan, correct, Bibi? Because that's what you refer to. A supplemental loan is a loan that you would take out while you have the original one in place, and it's based on the equity that the property has already gained. Yeah. Timing.
Yeah, let me chime in a little on this refi. Don't forget, refinance is a debt. You don't pay taxes on debt. So that is a very strategic way of preventing such. So I just wanted to highlight that, Ify.
Yeah, no, that's true. And again, just like with the 1031, timing is another issue. What are the correct, the current running interest rates? You may not always get the lowest interest rates. If you have, for those that have been coming from the single family space, all you do is just wait. You just wait until the interest rates drop till their lowest, and then you can refi at that point. But that's not always the case with commercial multifamily, because our debt isn't always this 30-year fixed amortized thing. It's going to balloon at some point. So you're going to have to exit, whether you want it or not, in 5 years, 7 years, 10 years, you're going to have to do something. So I guess the overall thing would be buy well, stabilize your assets, force appreciation, season your NOI, and then you can do your cash out refi. Is I guess the
Exactly.
message that I have.
Yeah. Yeah, and if you can't do any of those ones, because 1031 involves a lot of documentation, a lot of paperwork, a lot of coordination, and don't forget, you have your LPs involved. What if your LPs just want out? So
Yeah.
it has to do a lot of coordination with your LPs. What did you communicate with them at the beginning? That thing, you need to remember what you told them, what is in your PPM and all that. So it's not just for you to wake up one morning, I want to do a 1031 exchange. If that's the exit strategy you want to do, you have to have informed your limited partners, maybe through a webinar, and see if they like it or not. But don't forget, they also do not have a say on your decision making and all that, but you just need to communicate it to them on time and do the coordination with the paperwork. One last thing, if at all you're not able to refi, you're not able to do your 1031 exchange, another way you can go about your tax is pay them off their taxes, then ensure that they reinvest in a deal on time. They can also write off with a new deal when they issue them in UK ones. So for someone like us, I really don't like 1031 exchange because I want to also enjoy my money. It's not every time I want to defer a property. I want some cash, you know, I need to spend some money and all that. So, but I can literally do that because I know that I have a lot of write-offs and a lot of expenses for my properties, and I will use them against those capital gains I must have incurred. So that's another way. If you're a GP, you can use a deal to write it off. If you're an LP, you need to invest in another deal immediately, or before that
I think it's in the same year. In the same
in the
year.
same year, you need to invest in
Yeah.
another deal.
Full disclosure, we're not tax professionals.
You're not.
We are not tax professionals. We're not tax strategists. Consult with your CPA. But these are our thoughts.
Yes. Yes.
Okay. All right, hold on 1 second.
Please don't quote us.
Yeah,
Talk
no.
to tax professional. Yeah.
We sold our property because Bibi said so, and she said we could do such and such. Nah.
But these
All
are
right.
things we've applied, so that's why we can communicate that to you.
Okay.
Yeah, the next one is navigating legal and regulatory aspects. It's very important that you engage a legal perspective on this. Like on our team, on all our deals, we have legal professionals as part of our team members. When we're talking about team structure at the beginning, we told you the very basic kind of team members we like to put on our team. We want accountants, we want legal professionals, because these people help us to navigate these very critical professional roles that we necessarily do not have the experience over. So we engage them and they help us through this. And if you don't have them, you can also engage a third party person, because there are lots of legal papers. I don't see myself being pretty on a orange jumpsuit, you know. So it's very important that we follow the rules and what is and don't forget, the rules changes every time. Last year we were slammed with a lot of new regulations and all that. So even towards December, I know some of you have seen the LLC updates that we need to do. If you have an LLC, you need to do some things between some period of time and all that. So you need to properly engage a legal personnel during this period to help you mitigate the legal issues that you might encounter. So now the question is, should I sell or refi? Like I said, it's up to you. It depends on your business plan and the opportunity that timing presents to you. Things you need to consider when doing it is your original business plan and strategy. Do not forget. That is why we always ask you to, at the beginning, outline your business plan. Why did you buy the property in the first instance? What was the goal of it? When did you say you're going to exit? What was the plan? Was it a value add? Was it to just stabilize the property? All these things will come into play. So you need to know, what was the NOI that you said you're going to exit at? Did you achieve it? So if you've achieved it, why are you still holding on to the property? Why are you not exiting? So these are questions you need to ask yourself. Is the market permitting me to do it? Right now, it's not a very good time for people to exit because the interest rate, like we know, is not It's not friendly. But we know some people that maybe got a construction loan and they've executed and they just need to get out of it. It might not be a good time for them to exit, but they just have to exit because maybe the lender, they've already got into the balloon period for them to exit. Where all value add enhancement performed to ensure that the asset can be refinanced. Remember, your business plan was to either maybe do some little value add. After doing those value add, did you increase your income? Did your NOI go up? If it did not go up, then you might need to start reconsidering your strategy on what to do because you might not be able to refinance because all these things play a major role in it. There are some properties that are falling on our laps right now. And the reason is because these are properties from operators like us. And they brought these properties, they've done the value add, they've done everything. But guess what? The properties cannot be refinanced. The banks are not refinancing them. So they're trying to sell, and what are they looking for? They just want the equity. They're not even looking at profit. So you just need to know what you're doing. Your NOI, your interest rate, your DSCR, the appraised value, your market cap rate, those things all work together. They will either mess you up or make things good for you. So you need to watch it and properly do your projection. Like what I tell people, your exit starts from your beginning, your underwriting. I cannot overemphasize the importance of underwriting in your exit strategy. So if you've gotten it wrong at the beginning, except it was just a market that we had in 2021 that everyone was very successful. And everybody that could not even do a deal was able to do a deal. Everybody was a champion during that period because one, the interest rate was low and all that, except that is the period that we are in, which we obviously know we are not in that period. Then you just need to do the job and ensure that you can exit. Then what exit NOI? I just mentioned it. What is your net operating income? That is what we are up against, our net operating income, increasing it. And how do you increase your net operating income? Increase your income and reduce your expenses. Sometimes it might just be that your income can be static, but your expenses might be the one you need to touch on. Or your expenses might just be what the market is saying, and you just need to improve on your income. Other ways there are ways you can improve on your income through other incomes. Do not underestimate the value of other incomes. I've seen other incomes throw up a value as high as possible, make it very attractive enough. So if you need to start doing things to improve your property, you can start looking at your other income. Increasing rent is not the only way. There are other ways. So start looking at it right now. What is the interest rate at the time of sales? Very, very important. If your business plan is in 5 years and in your 4th year, you're seeing that the interest rate is going to go up, you might need to push it further out or exit at that time. But don't forget, you have prepayment and you also have yield maintenance. Those things will come and bite you if you do not take that into cognizance. Did asset lose value and it's in distress? Cut losses by selling. Sometimes you might have done everything you need to do. Sales might just be the way out, and that might just stop the bleeding. And that's what we are seeing happening. People are just selling, not just for profit, they're selling to just get their little equity out. I mean, in a deal as an LP on one of our deals, and that's what is happening. We are hoping that we even get the entire equity that was put in out. So we're seeing these things happen in real time as we speak. Was target IRR met? Don't forget, your IRR starts to decline when you've already gotten to that peak. So you can do a test and sample to see where your IRR is at its peak. That might give you a cue on it's time for me to exit. I've gotten to my peak. I need to return back the money to the investors. Because if you start to hold it way longer, it might start to decline, and the returns based on time that you've held onto the money might not be that significant at that point. So
Bibi, I have a question for you on behalf of the asset managers that are not the primary underwriters. So we know all these things, but we didn't underwrite the deal. We saw the original underwriting. How often should we be checking in with our underwriter, who's part of the asset management team, and asking, what's our IRR now? You know, how often, what's a reasonable time frame to
Okay.
check it?
Yeah, so like remember our previous episode when we're talking about KPIs. You will know when your deal is falling apart if you've been constantly following on it every week. I always tell people things don't just happen after 1 year. It must have accumulated over time and start to exhibit itself after a while. You might not see, it might not be that obvious in a short term, but in the long term, you see the implication of it. So, for example, if our target is to increase our property value by 1.5 Ify, and we are at 800, and we need to add an additional 700,000 to make that property at that time where we want to exit and all that. That means the remainder, what do you call it, 700. If my old time is 4 years, I will divide that 700 by 4. That means every year I have to make that amount. So let's do the calculation. What is 700 divided by 4? So 700.
That's like 175.
175. That means I must increase the value of my property every year by 175. And if I'm not able to increase it, let's say in year one for 175, that means in year two, I will have to double my effort. Most times in year one, you literally cannot do so many things because maybe you're increasing the value. So from year two, year three, you start to see the increment. So that means in year one, if you're not able to get to 175, that means in year two, you might need to get to 250 to make up for what you did not do last year. So to answer your question, Ify, things don't just happen like that. Constant checking on your deal weekly, monthly, quarterly, and yearly will help you mitigate. We don't know tomorrow. Things can happen that are beyond our control. We know that, but at least do the ones you can do to mitigate extreme risk. So that's what I would say about that.
Okay. All right. This is where you engage with us. If you have any questions about something that needs clarification, hold on one second. I have Latoya. Is it normal to know how much to allocate to maintenance before purchasing a property, or is there a standard formula to figure out how much one should allocate per month? Is it normal to know how much to allocate? I'm no underwriter, but I'm going to go with, not that it's a normal thing, you should know, correct? That's part of your due diligence. That's part of the research. You're not just, going based on what the broker said. You have to, I think you have to do some investigative work to know, in this market, for this asset class, how much will it cost for me to turn a unit? I don't know, maybe you go all the way down to like cabinets should cost this, and faucets should cost that, and fridges should cost that, or do you just, how does that work on your end when you're underwriting?
It's like we're talking about individual markets. Markets are different, so what is applicable? Because I came from the California market. When I mean California market, I was based in California before, and I noticed labor was very expensive in California compared to Dallas, So if I am making provision for maintenance, it just depends on one, the market. Two, there are some standard, like they say some standards are like 800 to 600 to 800 per unit. That's the standard we see. But sometimes, depending on the class of the property, if it's an A class, for crying out loud, A class it's a brand new property, for crying out loud. You don't need so much, it will not require so much repairs, but a C class, yes, we require. So one, it depends on the market, it depends on the class of property. And you can, if you don't know what it is, you can also go with the standard and all that. So to answer your question, Latoya, yes, you need to make provision for maintenance, because it's like you buying a phone. The phone will wear and tear. If you keep carrying the phone for the next 4 years, the screen might break. You just need to make provision for it and all that. So it's the same thing as property. you need to make provision for maintenance. Things, these are equipment, these are, you're not, even human beings wear and tear. The way I looked when I was 10 years younger is not the same way I look right now. So I do some maintenance on myself, you know, you go for facials, you go for pedicure, manicure. When you are a teenager or a young child, you don't do all that because you are brand new, you know. It's the same thing as property. The older it is, the more maintenance. You see people doing plastic surgery. It's all part of maintenance and it's expensive as the age becomes older and all that. So just look at it from that perspective. If I'm able to, I hope I'm able to communicate very well. Yeah.
I know my kids are young and they're kind of high maintenance, but let us move on to, I'm just saying, let's move on to Khalifa, I'll get your question. Give me 1 second. Isabel.
Hi, ladies. So good to see you. Happy New Year.
Happy New Year to you.
Yes.
Hi.
Hi. I love the comparison. I love everything. Towards the end, we got a little bit looser there. So that's fun. I love that comparison. It's very realistic. I love it. I want to ask you, Bibi, if you had experience or anyone with retail and class A, not retail, office and class A, because I'm going through some situation and I just wanted to,
Yeah.
run by you if you have, maybe not now on your current deals, but maybe before, something about related to elevators on, office with a mix of retail, of course, in the bottom, restaurant and class A, dealing with, high net worth folks.
Okay, I have a mixed properties, retail and residential all in one building, offices as well, all in one building, but it's a
Oh.
class C, it's not a class C. So it depends on the question. So what exactly is the thing you want to ask so that we know if we can answer it?
Yeah, no, it was just like, I'm not going through that right now. I have had that on when I was managing, office and mixed use and with retail on the bottom. I didn't have residential. I did have that come up, and it was so difficult because it's how to turn the elevator, to separate the elevator use just for retail and make sure that, it's not mixing with office tenants. I vaguely remember when I had to go through this 2 years ago. It was very difficult for the elevator companies or data watch, the monitoring company to figure out a way to separate that use. And this just came up and I'm like, before, I have to really put my hands on it, I was just curious about it.
Okay, I've not had this issue, but this is what I will say about it is, first of all, why are you guys doing it? Is it going to improve your value of your property? Is it going to increase, because you're doing it, can you increase your rent? Is it going to give you any monetary value on it? If it's not going to give you anything that does not put extra money on your plate, don't do it. Because you're just spending money that has no returns. Like today, we're talking about expanding, using part of our leasing office and combining with another unit and creating a brand new unit that we can rent. But the bottom line is, what is the cost of doing it and what is the returns it's going to give to us? So if that thing will not translate into profit or additional value, increase the value of the property, then you shouldn't do it in the first instance. But if that has happened, it's going to give you profit and all that. I've seen cases, the way they do condos in skyscrapers where you cannot get to the highest floor. It's just secluded. So you have a key, a card key that only people that are supposed to be in that you only have access to floor, maybe from floor 1 to 5. Then
Yeah.
from floor 6 to 7, you don't have access again. So these are things you can introduce. You necessarily do not have to create a new elevator. You might just need to, build a new elevator. You might just need to change the
hours. Yeah.
elevator system that will
Yeah.
permit you to prevent people from getting to another floor
Mhm.
since they don't have access to it. So look at it from different perspectives. The bottom line, if it does not translate to money,
Mhm.
don't do it.
I like that. Yeah. Like I just wanted to have like a refresher. Like I said, I dealt with that about 2 years ago and it was I don't know why, but the elevator companies were not finding a way. The monitoring company was not it was difficult. All I remember was that. And I don't remember, my memory is awful because I'm at that age. This is a lot of fixing to be like this.
Yes, that's the high maintenance we're talking about.
So I don't remember, and I'm like, this just came up, and I was like, yeah, I was like, I just froze, So thank you for saying that, and I think the difference on this case is because it's luxury and it's class A. I think they might not be so concerned about like the return that by itself will turn, but I think they're concerned of like not mixing people, not making sure that I guess vendors for the restaurant is not going to go up to the office,
Then do what they do in condos and skyscrapers and those celebrity buildings. That's what they do. You don't have access. They can have a club in maybe in the middle floor or a restaurant in one of the floors. You don't have access to some floors. There's a way to create the access. It's just about access and all that. A good elevator company should know what to do.
Yeah, but I think by now, I don't remember exactly what happened, but by now I think that should be easier. Okay. So thank you.
Thank you,
You're
Isabel.
welcome. Isabel, check the chat. I don't know if the comment from Lisa is directed to you.
Okay.
But something about a company called Butterfly that might be
Oh,
able to.
yeah. Thank you.
I have a question from Khalifa, and I think he's referring to legacy assets. So he's asking if the IRR depends on the market. That's one question. What's an acceptable IRR in general? 2 questions. Khalifa, on Mondays, we only accept 2 questions. Like you're asking one more. This is unacceptable. Let's go one by one.
One at a time. Sorry, guys.
Wait,
one at a time, Ify.
Okay, hold on. Okay.
One, then another one. Yeah.
Is the IRR dependent on the market? Let's start with that one.
Okay. IRR is dependent on the deal. So every deal is unique on its own. So I can be in the Texas market, and I can decide to hold on to the property for the next 5 years. And I can be in the PA market, and I can decide to hold on to the property for 3 years. So one, it depends on the deal. What is a combination of IRR? Have we ever thought of that? IRR is a combination of one, the cash flow, the refinance proceeds, the sales. So whatever money that you're supposed to have gotten out from the deal are all combinations of what will give you the IRR returns. But in this case, it is due to time, the time of hold. So I'm holding on, you invested 100,000 on a deal, and I'm holding on to that deal for the next 4 years. So the returns I'm going to get is how do I put it? The returns I get is a sum of the IRR based on time and all that. So it just depends on the deal, like I said, not literally about the location. Location plays a role because there's some markets that gives you large returns, and some returns, when I mean return, I'm talking about cash flow. There's a market that gives you large cash flow. There's some markets that give you large appreciation and all that. Like what we are seeing now in Texas is for A and B class properties, we are seeing more of the cash flow is small. We are seeing them as maybe 5% average cash on cash. Then market like PA, we're seeing their cash flow like a deal of we want to introduce to some of our partners, the cash on cash is 10%, you know, but guess what? The sales is small and all that. So all these things are the things that create your IRR. So what I would say to this is determinant on the deal. The market also plays a role, and some other factors. So the next question.
Well, let me ask question 3 before 2, based on that. So if you're going to hold on to the property forever, right? Does IRR even matter? If all you're going to do is continue to refi, pull out cash, refi, you know, does IRR matter if this is going to be a legacy property?
Yeah, so IRR as a strategy is just a way for you to ensure that, one, you don't have a lot of equity on your deal than what you're getting out of it. You bought a deal for 1 million and you're making good profit, let's say 200,000. And all of a sudden, after 6 years, that property has become let's say 8 million. I'm just using this as an example. You bought a property for 1 year, after 6 years, it becomes 8 million. Your equity on that deal is so much. And that does not, for the fact you have 8 million equity does not mean that your returns has even increased, because you might have gotten to the peak of how much rent you can increase, how much value you'd have added, you've gotten to that point and all that. The best thing for you to do at that point is to exit. So if it, repeat the question again, I've lost my train of-
No. I think what you're saying is true. If the person's goal is to grow wealth, right? Your goal is to grow wealth, then you don't want your equity all sitting down there, tied up, locked up, and you know, you just can't tap into it. So his question was, what about investors that hold properties forever?
They need to you can, like, we have properties that we are going to hold forever, but we'll not like literally hold forever. We'll be refinancing the property every time, because a deal needs inflow of cash and outflow of cash. You need to remove that money. If you've been able to, inflow of cash is pumping in money from your investors and increasing the value of it. That is when you have the inflow. You pump in money and increase the value. When you've increased the value, that means the value of property has gone up. You need to take it out again. So it's in and out, in and out. You can keep doing that for as long as you want. We have that in our plan. Our business plan for that is to keep refinancing until we no longer can. So for a legacy property like that, keep doing that. But anytime you refinance your property, try and, you know, look for ways to increase the value of that property. Because if you don't have any way after refinancing to increase the value of the property, then that might not be a good solution for you. But another thing you should not forget is that over time, properties tends to improve, but multifamily is different because ours is based on the NOI. How much NOI can you raise from it? So look at it from that perspective. And multifamily and single family are two different things entirely. So you're exiting from single family and exiting from multifamily. There are different conditions you need to consider. If I'm going to keep refinancing, that means I need to keep putting more value on that property as we keep going. So that's my advice to you, because I'm going to do that. That's what we're doing.
His last question is, what is an acceptable IRR, like in general?
It's dependent on you. It's for you. In general, some people do 14%. That is the like worst case scenario. I see people doing 12, but mine is 17. So it's you. You decide what is good for you and your investors. Your investors kind of call the shot. So your investors will tell you what they're looking for. So that can set your IRR for them. But for me, I know I've seen many investors that like 17%, but I've also seen investors that are okay with 15%. As long as the average cash on cash is 10%, they're very fine. They're more interested in cash than the overall return. So it's just up to you.
All right, awesome. Thank you. So you're welcome, Khalifa. So for next week, again, remember next week will really be from a chronological perspective. In 2 weeks' time, we will be bringing on our first guest. excited to bring on Cindy Harding. She's an asset manager, and I would encourage you guys to all come. She comes packed with years of experience. Fun fact, she's the asset manager on one of the deals I'm partnered into, and we're super excited to have her on. And Bibi and I will be having a wonderful chat with her, and we'll expect that you guys come with questions. It's good to hear from Bibi and I, but it's also good to hear from other people, right? Variety is the spice of life. So come packed with questions, and we hope to see you. We hope to see you there. And then lastly, I do want to say that, we've tried to showcase some of the deals that we're in. We are always in the market. You hear us talking about deals we've closed on, or deals that we're putting in offers on, or sellers we're talking to, etc. We're actively buying, we're actively partnering with people. Would love to partner with you as well. You can obviously put your information in the chat, and I can put in our Calendly links in the chat as well if you'd like to connect with either Bibi or she's the more fun one. So you can connect there.
I think so. I doubt.
And MFC is kind of trying to be a little more respectful of everyone's time. So we're trying not to go too much beyond the 1 hour time limit. So don't know if you guys have any questions. If you don't, we'll sign off here and hope to see you in 2 weeks when we bring on Cindy Harding. All right.
Thank you, ladies, you're awesome.
Mohammed's asking for a phone number. Thank you so much, Isabel. Mohammed, let's start with our emails and our Calendly. Calendly, you'll be able to see us over Zoom. And then we would happily text and share phone numbers, etc. beyond that.
Meetings and Mohammed. I have.
All right.
Then let me send you a private message.
All right. I'm putting my sign-off music.
Thank you all for coming.